What's up guys, welcome to another episode of the Real Life CFA. In this series, we're going to talk about all the important concepts in the CFA curriculum. So the topic for today is DCF, discounted cash flow. As always, let's start with the definition. What is DCF? Discounted cash flow, DCF, is a valuation method used to estimate the value of an investment based on its expected future cash flows. So the next question is, how do we perform a DCF valuation? Step 1. Project out free cash flow for 5 to 10 years depending on the stability of the company or project. Step 2. Determine the terminal value of the company or project. There are mainly two approaches to this. First, exit multiple method. For this method, you need to assume the company or project will be sold on a valuation multiple such as EV over EBITDA or EV over EBIT or EV over sales, whichever one that you seem fit for this specific company or this specific industry. The second method is called growth perpetuity method. For this one, you have to assume the company's free cash flow will grow at a steady rate forever. To calculate the terminal value using this method, you can use the following formula. If you look closely, this formula is exactly the same as the perpetuity formula with a constant growth rate. Step 3. Discount those projected cash flow and terminal value back to today in order to account for the time value of money. Sum these discounted values to determine the enterprise value of the company. Step 4. If we use unlevered cash flows, we need to subtract net debt, preferred shares, and minority interest to get the equity value of the company. Then we divide it by diluted shares outstanding to find an intrinsic value per share. The DCF model may sound simple, but it's actually very complicated. You'll see why in a second. So today, instead of sharing a real life example, I'll share a real life story, because a real life example will be so complicated to explain it in a video. But I promise you the story is much more fun. So I assume everybody knows Morgan Stanley and Snapchat. So this story begins with Morgan Stanley made an error in the Snapchat valuation, and then they came out to correct that error without changing their price target. How did it happen? We'll see. According to Business Insider, Morgan Stanley published an equity note on Snapchat, putting a $28 price target on the stock. Almost a day later, the bank issued a correction, changing a range of important metrics in its financial model, but not the price target. Imagine the following scenario. A Wall Street investment bank has led the biggest tech IPO in years, but make a mistake in the first research note it published on the stock. So the investment bank is Morgan Stanley, and the tech company here is Snapchat. The error means the bank overstated the forecasted earning over a 5-year stretch by nearly $5 billion. Yet when the bank issues a correction and updates its earning models, its price target on the shares remains the same. How does that happen? So the answer says a lot about the weakness in Wall Street analyst research and also about the DCF model. So Morgan Stanley actually cut the estimated adjusted EBITDA of Snapchat by $1.7 billion, which means they have also cut the free cash flow. With a lower free cash flow, how do you maintain the price target? Using the DCF model that we just learned, the only way to do it is to lower the discount rate, which is WACC, weighted average cost of capital. If you want to learn more about WACC, please click the link above. So I guess the Morgan Stanley analyst must have reverse engineered with the fixed price target of $28 with the updated free cash flow to get the new discount rate. So this story tells us two things. First, the DCF model may sound simple, but it's actually very complicated because it depends on a lot subjective assumptions, such as discount rate or projected cash flow. And when it comes to valuing a company using DCF, Nobody is absolutely right or wrong. Everybody has their own assumptions. But of course, if everybody used DCF under the same assumptions, then you should get the same results, just like the CFA exam. So the second thing is, equity research from a sell-side bank, aka investment bank, are usually biased or influenced by their client. Because you see, a client asks you to write a report about their company. In order to keep a good relationship with the client, you have to give them a price target that can satisfy them, right? Otherwise, you lose this client. Whenever you hear Goldman Sachs raise price target for this company or Morgan Stanley decrease price target for another company, don't just look at the headlines. Look at their rationales and try to value yourself. Those headlines cannot be trusted. So the pros and cons of DCF. For pros, DCF considers the fundamental drivers of business, and it's also one of the most popular fundamental analysis tool, and includes all future expectations about a business. And most importantly, it allows for sensitivity analysis and scenario analysis. What it means is basically you can play around with this model, change all the factors in it, and see how the price reacts to the changes. For cons, it is very sensitive to many subjective assumptions, just like I mentioned before. Every analyst will have a different projected cash flow for the same company. Every analyst will have a different WACC or discount rate for the same company. That's why their price target will be different at the end. The model looks at company valuation in isolation. Because the model depends on so many assumptions, it actually isolates itself from a lot of other factors, such as how the economy will influence the cash flow, or how their competitors will influence the cash flow. And last but not least, the model is overcomplicated and overconfidence. If you have any questions on this topic, or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching and see you next time.